It is earnings season in earnest now. Today, I had probably 5 calls that I listened to that were new and then a few that I was just reviewing. But State Street is going to be the topic tonight. And State Street is usually the sleepiest company. Don't think I've ever done a video on State Street because it just hasn't been necessary, but down 10% today because it missed earnings. I had to at least take a look, especially because we're in this kind of weird financial environment. So I am going to go through State Street. It sits in the most unique place. And the other night on my bank review of what happened on Friday, I did discuss the fact that I was a little bit concerned about the custodians. Yeah, I should have been even more concerned, quite frankly. But in fairness, to cut to the punchline on this, I do think it's actually a little bit overdone. But am I necessarily going to get into it? I did a little bit as a day trade today, truth be known. But I mean, it just depends on how this market trades because it's such a skittish market right now. The market up and this one down kind of bothers me a little bit. Okay, let's get into it. Past performance is not indicative of future returns. You guys know that I'm all over the financials in different spots, so we won't even talk about that. I do not currently have a position in State Street. I believe I closed it all out before the end of the day because I just didn't want to carry it through. And format-wise, I'm going to try to keep to this format, even though I always veer. We're going to do the headline number, the overview and description. I'll talk about the business lines and then I'll go deeper into it because I do think that for anyone that's looking at State Street, especially if you've never worked in asset management or even you really do need to work in asset management because my impression is that if you probably only worked in investment banking or on the sell side or at a commercial bank, this would be very hard, in my opinion, to go through. State Street really is in a funky place, even within asset management. So the beauty of State Street and the reason you should attempt to try to listen to it and the reason I typically listen to it is because given where they sit, you can get a lot of intelligence on a lot of different things in the marketplace and how to think about fund flows. More so and different from a BlackRock. So let's go into it a little bit. Okay, let's see, bank earnings season. All right, so the headline number, that was not great, for lack of a better way to describe it, because this thing doesn't move very much. Okay, so down 9% on top line. Well, actually, it's really flat if we look at this 1081 101, but the fee revenue, which you typically want to think of them as getting most of their income from, was down 9. I think that's what freaked people out. And then net income was down 9%. Although it's kind of interesting because it kind of depends. This was in the report because they also added in a couple of other things. But the actual headline number that you saw reported and that they discussed was down 3. Hold on, let me just show those financials so you guys don't get into it the wrong way. So this would have been a different view that you saw, and you would have seen up 1, as I mentioned, and net income down 3%, diluted EPS down 3%. And that's because they bought back shares, essentially. And it's a little strange to have this kind of announcement and then buy back shares, especially because you do have a bank holding company attached to you. But they are not worried about liquidity. And quite frankly, when I look through it, there's maybe one thing, but that I could say could require that you have bigger issues, but quite frankly, I don't even think that's realistic. So in net, they're probably fine. But I do want to kind of go through some things here. The first thing I kind of want to go through is the left part of this slide. I think what makes this company so hard for people to understand is the way that they divide out their financials. And this, as you can see on the financial results, would be a mess unless you just know the asset management business cold. But really, an easier way to think of it is what they write in their 10K, but still could do a little bit better to articulate, which is the investment servicing business and the investment management business. And what the investment servicing business actually is outsourced services for the asset management industry. So, for example, especially with this last acquisition, if you needed a certain type of data, your accounting, which is probably where a lot of their acquisitions were, trading systems. They purchased Charles River a long time ago, for those of you that maybe do know some of these companies. And then they just purchased CF Global, which is more of a trading desk services. So those service businesses are fee based, and they're very ultimately they will become a software as a service business, and they're very reoccurring, pretty straightforward businesses, but fair and square. If assets under management increase and decrease, they're going to have some exposure to that. And in there, I'll show you on a different slide, but they will be ever so slightly more exposed to equities by a lot. So if the equity markets are not doing well because of the nature of how they charge, they will absolutely be impacted by that. Then you have the investment management business, and that is primarily two businesses, in my opinion, on how you describe it in simple form. Okay, the first one is primarily a passive investment business, not to be confused with active management. They do have some active management, but most of what they're making money on is ETFs. There's not a lot of investment decision making going on there. And then they have the custodian business, which is essentially the business where you hold your assets there. And it's all right. There'll be some people that'll be upset with me, but the closest thing that an average person would have experience with would be kind of like if you had an escrow account. And but the custodian business does way more than that, because most of their clients are here, I'll just take it off share, because most of their clients are asset managers. If you think about when you put your money with like a Fidelity or something like this, and you notice that you get an individual fund statement, there's actually an administrative thing that's happening there. And the part that's the investment services part does all the math so that everybody gets the right statement for what they're supposed to be doing. And then the part that is the custodian part is the place where your money actually is. And so the two businesses kind of blend and go together very nicely. However, I would say this: the fact that the two businesses are one business at State Street does make them a little bit of a different animal, and in a lot of ways, it hurts them from a valuation standpoint. I'll do that last in this slide, so in this presentation, so you can kind of see it. But as a result, there's lots of intelligence to be gained from State Street. Okay, going back into it, I'll share my screen. I do want to highlight this, the securities financing, because if you look across all the different businesses, don't worry too much about where they're coming from. The back office services and middle office services, that's all down approximately 10%, no matter how you slice it. And then we get to this 15% business piece of the business, which is the securities financing business. And what is that? That's actually stock lending for all my AMC folks and all the folks that are all meme stock oriented, that for whatever reason, thank you, are following me. You can actually go and just look up State Street finance securities lending or State Street's securities financing, and you can see that what it is that's happening here is all of the passive funds that they have. These are the funds that they lend out on the emerging market side, but there are some others that they list. They have a whole spreadsheet that they allow you to download that shows you what exactly they're lending, which exact stocks and what fees they're gaining on it. It's kind of interesting. So realize that really does make a lot of money for State Street. Also makes a lot of money, by the way, for BlackRock and others. And I have said it before, and people have been like, why does she care about the borrow rate? Or, in other videos I've been criticized because I, mentioned that the 600% interest rate that these guys are receiving has them incentivized a particular way. So there you go. Okay. You can actually find this on the income statement and in the earnings reports. And specifically for State Street, they will actually allow you to download the spreadsheet of what they actually receive. However, again, a reminder, these guys are passive investors. They're not actively trying to stick it to the man or anything like that. Okay. So there's that. All right. Just wanted to highlight that because I thought some of you guys might think that's interesting. But back to our story, this is what got folks really upset. It was this, the loss of assets of to the tune of 10%. This is assets under custody. Assets under management is also down 10%. They're ever so slightly different. Okay. Assets under management for these guys is going to be coming from the ETF mandates. And then to a lesser extent, they don't really do active management per se. I don't think that's quite the right way to do it. What they'll do is cash management. So that's going to be more like foreign currency or if someone has deposited and let's say they're a European client, they have to manage different cash in different currencies across so that the investments can get through. That's what that business is. Okay. It's not quite like BlackRock's business for the most part. They do have some State Street funds that would look similar, but largely speaking, it's primarily passive, whereas BlackRock's going to be passive and active. And then assets under custody is more kind of like the bank account stuff that I was talking about before. And that's also down 10%. And what they said was happening was that asset managers, even though operationally they were going to keep as much as they wanted, because interest rates have increased so dramatically, they're basically they're basically moving their assets to higher interest bearing accounts. In some cases, State Street matches that. In other cases, they're just not going to be able to match that given all the services that they're also doing on top of it. And so that little float, which somehow came to 10%, which is a pretty big chunk, I'm not going to lie, is what it is. The other thing that I would mention too that kind of goes, it's actually something that you would just know offhand. The increase in interest rates, by the way, also is helping this securities lending business. Just FYI, in case anyone didn't know that. So it's a bit offset in some ways, but between the decline in values of portfolios and also this other dynamic that's happening, that's what you've got going on there for State Street. And then other things, the market data business is pretty resoundingly cash flow. Okay, so we can see assets under management here. I wanted to show this because I always think it's really good. This assets under custody. And what's great to look at for them is just where the money flows essentially. And you're seeing them come out of equities, which is what we saw at BlackRock. And oddly enough, it even for them came out of fixed income, but to a lesser extent. Some of this is just redemptions, et cetera. And then out of short term, and then going into short term investment. Okay. So this looks ever so slightly different at State Street than it does at BlackRock. And the relevance of this is that in a couple of different videos, including for the private equity business, I talked about the fact that a lot of these funds were pulling money out to cushion for the market doing whatever it is and then come back in at another time. Additionally, this also would be cushioning for redemptions, meaning like if a liquid fund knows that it's going to get a redemption, most of these are liquid assets, and it's going to go somewhere else, and they would bring the portfolio to cash before redeployment. So my suspicion is this is what's being said. This actually is an intriguingly positive sign, potentially positive sign for the marketplace because it does speak to dry powder. However, if this then disappears, then hard to say. So we'll have to watch this for another quarter. They also indicated that what they saw was the first part of the year. So the first quarter includes the early redemptions from January, February, which is seasonally going to be pulls from capital as people reallocate at the beginning of the year. They have a little bit of a different business mix than BlackRock proper does. Nonetheless, they started to see significant improvement in March, and then you had Silicon Valley Bank. And so the cautiousness with which they were talking about how to think about this was much more muted than it would have been. It was much more aggressive. It would have been much more muted otherwise, because if anything, they started to see the turn, and then Silicon Valley, and then here we are. But they did mention that they saw an improvement towards the end of the month of assets flowing back into the various areas of investment. So that I thought was interesting intelligence on what's going on with fund flows. Final few things. Yeah, let's see, we'll skip that slide, a little bit less relevant. CET Capital. Now this is where this is a decent buffer. Okay, it's a little bit lower than it was in the fourth quarter. Some of that may be from funds pulling out and into deposits. It's not really going to be funds like funding leaving in the same way, because they can't really have, relative to other types of financial institutions, it's not really the case that they can have a run on bank situation because of the nature of the business. Additionally, they don't really take on the same duration mismatch situation because of the lead time that you get, because of a lot of other stuff. So I'm not worried about this being something weird here on a liquidity front. And what we're really looking at as relates to the custodians, the trust companies, et cetera, is whether they did anything odd on duration, whether there's any impairment from the fund level that's seeping into the bank, and it's really kind of this, or alternatively, if it's just an overall decline and shrinkage in the stuff that's actually there to begin with. So, what do I mean by that? I think where they can get into a little baby bit of trouble is if you have a whole asset class or even one very large manager blow up in a blaze of glory in a way that they couldn't see clearly through the administration business. It doesn't happen all the time, but we had a few special sauce incidences in 2021. As you guys know, with Archegos, et cetera. So that would be the only thing. But truth be known, this actually looks pretty good all around. Sorry, I always need to turn off certain things, but I didn't on the bells. So I'm actually comfortable with the liquidity. Other than that, loan loss reserves, I'll mention very briefly. They did increase loan loss reserves, but that means something a little different to a custodian. And then finally, oh yes, I just want to do one quick thing on valuation. I know I've got some folks in the chat that I want to acknowledge. Let's see what we got here. Valuation, what is a little bit interesting is that while I think from a business perspective, there are real reasons to keep these businesses together, which is the fund service, institutional services or investment services business, along with the fund management business. The fact is, it makes figuring out what the valuation should be a little bit difficult. And really, all of these three businesses, which are more these businesses, as you can see, get a better multiple than State Street does. That's the only reason why I do think it might be ever so slightly overdone, unless you want to value it like Northern Trust. And Northern Trust will report a little bit later, so it's hard to know if Northern Trust might take it on the chin when they report. If I had to guess, there might be a little bit of stuff, let me say. But some of it they took already last quarter, which State Street didn't have nearly the same issues. But I do want to just talk through it. BlackRock is probably a fairly close comp, but they have the active management piece, which we talked about the other day, that funds were going from passive to active. So my suspicion is BlackRock probably deserves a higher multiple no matter what. Plus, BlackRock has about $1 trillion in assets, which is about double what State Street's got going on. A little bit more than double, almost triple, to be fair. But FactSet does a number of fund services. As you can see, it's a pure play fintech, which is what would happen if you split those businesses apart. You get a pure play fintech, and that has almost a 30 multiple. Okay, so that's one of the things that I'm sure different people have asked State Street before. You're going to split these businesses up or what? And then Northern Trust, like I said, is custodian business, and I do think that they are looking to sell parts of the custodian stuff. And they did just buy, like I said, more exposure to kind of the institutional services stuff as well. So that's what makes it tough to value this thing and think that it should go higher, because being the first trust company to come out and knowing that it's not ever going to be BlackRock, with all due respect to State Street, then how do you value it? My suspicion is that maybe ever so slightly overdone today. But like I said, I think there's just so many opportunities in this marketplace to deploy capital that I don't know that I'll necessarily more after today. This is still just the beginning of earnings season. There is a lot that still needs to come out. So just realize that. And then with that, I want to take some questions or acknowledge. Sean, thanks for stopping by. I know it's a rather late episode for me. Juicy got you crazy. Always appreciate you. We ate both number one BB. Okay, very cool. Very cool. And then short FRC. All right, we're going to find that out coming up. So I do, I still think strangles, there's so much negative view in this, that's the one thing that bothers me, because before this quarter, this would have been a little darling of a bank. And now let's kind of see what happens. It seems like there's a lot of support even within the financial community as relates to even banks putting deposits at FRC, that it always makes it a little scary for me to want to short something like FRC. So I do have, as I've mentioned before, strangles on this one going into earnings. And we'll see. So I've got risk on both sides, meaning I'm long a call and long a put on this. So with that, I won't keep this episode for too long, and I appreciate all you guys. Tomorrow, there's a bunch of banks coming out, but I will be doing a recap on Netflix, which reports after the close. So please do stay tuned for that one. And if you like this type of stuff, please do hit the subscribe button. Bye, everyone.